Are we in a situation similar to the roaring 20s? Are we going to go into bubble mode and crash mode? This is what we are going to talk about today. Because as you probably know, the stock market right now is expensive. You have a lot of tech companies that are only going up. Stocks that are related to AI are just shooting up and up and up. And some people say we are in a AI bubble because you don't have much earnings coming from these companies. Companies invest a lot in AI, and so far the return on investment is not that significant. So some people say we are still early because ChatGPT is only 3 years old. Some other people say that some valuations are crazy high. This is what we are going to do, and we will do so by watching this wonderful video from the compound and Ed Yardeni. So they will compare different periods in history and the kind of returns you can expect. So if you are hesitating whether we are right now in a bubble, this video will help you. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I'm achieving my goal of 25% per year CAGR this year, also into 2025. So yeah, looking forward to seeing how the rest of the year will go. But yeah, I wanted to react to this video because I think it will give you a lot of value.
2029, and that's only likely to happen if the economy remains resilient as it has for the past several years, absorbs shocks remarkably well, and
into this roaring 2020s, and they had back then the radio and some other technologies. Of course, we have AI, but it's just been remarkable, and you've stuck to it. You never declared victory. You never said, all right, I got it right, it's over. You've been sticking with it, and it sounds like you're sticking with it for 2026.
I'm definitely sticking with it for the rest of the year and going into next year, and then through the...
In case you don't know who Mr. Yardeni is, he's one of the best equity analysts you can have out there. Major research person here. He has been doing this job for decades now, accumulated years, decades of data to have this masterpiece of a research company. And you can check his website, you can check what he has written, you can check what his team thinks. And sometimes he comes to CNBC, sometimes he comes to podcasts, and always he's like a historian. He compares what we are living through right now, he compares this to the past to see if we are at an expensive territory or not. And he will make comparisons to what we've been through 100 years ago, okay?
End of the decade. I'm talking about 10,000 on the S&P 500 by the end of 2029, and that's only likely to happen if the economy remains resilient as it has for the past several years, absorbs shocks remarkably well, and that'll only happen if earnings are remarkably strong. So that's my base case. I mean, I can see alternative scenarios. I'm not saying that things can't go wrong, but I have been seeing a lot of similarities with the 1920s. 1920s ended badly. I don't think this is going to end badly. I think I'll be talking about the roaring 2030s. So no rest for the weary.
From your lips to God's ears, roaring 2030s. We were very happy with that.
To what do you think the economy owes the stock market for its resilience? Is it a combination of the hyperscalers as well as fiscal accommodation? Like, we've had so much shit thrown at us over the years, and we just continue to grind through. Not perfect, of course. There's pockets of weakness. You don't have to squint too hard to find them. But by and large, in the aggregate, we're going up and to the right.
By the way, these are great interviewers, great questions. You can subscribe to their channel, The Compound. I think they have maybe the best finance-related podcast when it comes to stocks. And Tom Lee is saying the same thing, saying that for the past 5 years, the US economy has lived through several shocks: COVID, inflation, war, supply chain issues, some geopolitical conflicts, and despite everything we've seen in the world, all the negative headlines, well, stocks are going up because earnings are going up. So we will see if Ed Yardeni is thinking the same way.
Yeah, I think there are a few reasons why the economy has been so resilient. We had a terrible, great financial crisis back in 2008, 2009. We did restructure the banking system. The credit markets developed some very important shock absorbers like the funds that are always looking for distressed assets. When a private credit blows up, it blows up in a diversified portfolio. So if somebody's going to get a haircut on their rate of return, but it's not like the banking system suddenly goes into a credit crunch. So I didn't think we'd have a credit crunch, and we didn't. We had a financial crisis in 2023 that lasted, about one Friday, and then by Monday it was...
weekend.
Yeah, the Fed is really good at playing whack-a-mole in the financial markets and throwing liquidity, and the Fed put...
Yep. Maybe you were not invested in spring 2023, but it was panic time. Panic time, and a lot of CEOs completely panicked online. People on Wall Street panicked. People went on CNBC to cry. And eventually, in one weekend, the US administration worked with regional banks and they saved everybody. So that's it. This is something we didn't have during the Roaring 20s. We didn't have a lot of the Fed. The majority of the stock owners were not retail investors. The world was drastically different back then. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video.
They've kind of become real masters of the Fed put. The other important development, which I think I got, was and I have an inside track on this. I'm a baby boomer, and the baby boomers all my friends are retiring. I'm not. I'm still working for a living. I got 5 kids and still helping them out. But my friends who had maybe 2 kids, are young adults, they're all cruising around now. They're going to restaurants. They're checking out where their healthcare provider, just to make sure they can climb Mount Machu Picchu on their next vacation. And they're spending money. They have $80 trillion of net worth. It's the wealth.
Just your friends.
Just my friends.
So they're not bothered by higher interest rates.
They love them. Are you kidding?
They love them.
They absolutely love them, and they love the fact that they can't spend money fast enough, because as they're spending the money, they keep looking at their net worth and it keeps going up with the stock market. So again, it's the wealthiest retiring generation ever. And by the way, from my observations, a lot of my friends are helping their young adult kids with things like mortgage mortgage payments, helping out maybe with the grandchildren's after-school activities. So a lot of that just isn't really being captured by the standard talk about, there's only one kind of consumer, and not really understanding the varieties of consumers. And then, as you mentioned, I've been talking about the digital revolution. The digital revolution started in the mid-'60s with the IBM mainframe, and it's evolved to the point where we now have AI. To me, AI is just an amazing application. It's kind of like, we had Word and Excel back in the late 90s, and once everybody used them, it was like, is that all we have? Well, along the way, we got a lot more applications, but AI is an application that lends itself to just about every business and all of our personal lives.
By the way, he mentions the rise of the computer technology back in the 60s, 70s. Peter Lynch also mentions this. And if you had invested in computer companies back in the days, you would have lost money. It's not always good to be the first in an industry, because competition will come and competition will eat you. So most companies from the 60s, computer companies, went bankrupt because of this new wave of technology that attracted too many competitors. Same thing with the dot-com bubble, because you had plenty of companies. You had like pets.com, companies that were not that important to the world economy, right? So who cares about pet.com? Who cares about these small software companies? The world could live without these companies. Now the big boys, what is driving the market right now is Nvidia, Google, Meta platforms. Can the world live without Nvidia and Google? I doubt it. Can the world live without Amazon? Yes, but at what cost? Can the world live without Microsoft? I doubt it. You have alternatives, but the world will suffer. It's not the same thing if you want to compare apples to apples, compared to what we had during the dot-com bubble, for example. I mean, pets.com could have gone bankrupt and nobody will really suffer. Now, if Microsoft disappears tomorrow, companies will suffer. They have their entire back office system designed with Microsoft. If Meta platforms goes bankrupt today, my generation will cry, and plenty of people will have some depression tendencies. Same thing with Google, plenty of people will be affected. So you can draw similarities between different cycles of technology, and it's very difficult to invest in this new wave of technology because every time is different. So you have to invest in the same thing. Profitable, growing companies that have a competitive advantage. And Ed Yardeni mentions the 60s, I mention the dot-com bubble or this environment with tech. The same criteria for good quality investing is the same. You want companies that are growing and profitable with a moat. So the key takeaway here is do not buy anything related to tech just because it's tech, right? Only invest in winners. Let me continue.
And I think it's just kind of starting. And technology is something where you can rent. I mean, when you go on the cloud, you can rent Microsoft Office now, and you don't have to upgrade it. You can have one IT person working remotely. So all these factors have been very conducive to the resiliency of the economy. And oh, by the way, we do have a rather large federal deficit. And I've been telling people I'll worry about it. I'll worry about the debt. I'll worry about my friends, the bond vigilantes. I'll worry about all that when the bond vigilantes worry about it. Right now, the bond yield is 4%. It's pretty calm.
Yeah, we heard a similar sentiment from Steve Eisman, who basically said, I'm on Wall Street 35 years. I've been hearing about bond vigilantes the entire time, the deficit. I'm sure it'll matter one day. It's not going to stop me from investing today.
Steve Eisman, Mr. Eisman is the person that is on the movie called The Big Short. And who is the actor? Steve Carell, that plays the role. He spotted the subprime crisis before everybody, and he benefited from this crisis. And now, every week, he is asked if we are currently in a crisis, in a bubble. He says no, as long as the earnings go up. And now, earnings for tech companies are going up. So, yeah, Steve Eisman is here and confident about the resiliency of our US economy.
But I'm sure it'll matter one day. It's not going to stop me from investing today.
Hold on. Ed, you invented that term, did you not?
That's correct. Back in
bond vigilantes. Yeah.
Yep.
So that's how long people have been worried about the bond vigilantes.
Yeah, I have a shelf just on my bookcase just devoted to books from the 80s and particularly the 1980s. Things like Living Beyond Our Means, The Debt Bomb. I mean, when I wrote my piece in July of 1983 and introduced the concept of bond vigilantes, I said they're worrying about $250 billion in annual deficits. Now we're talking about 1.5 to 2 trillion.
Yeah. I want to go through some of the specific things that you said to set up this roaring 2020 scenario. And I guess, and I have your charts. So I'll set you up, and you could explain what we're looking at in the chart. To
Okay.
start with, S&P 500 operating earnings rising from 268 per share this year to $310 next year,
Right.
$350 in 27, $400 in 2028, $450 in 2029. This will require the S&P profit margin to rise to record highs in the coming years in response to faster productivity growth. And John, I think we have that as figure 8. If
Yeah.
we could want to pop that on screen so Ed can react to it.
Yeah, that's it. Yeah,
Okay.
I just wanted to show that I think an admittedly optimistic, but I think a realistic scenario that could get us to the kind of earnings level that would justify the S&P 500 climbing to 10,000. I think by 2030, which gets us into the next decade, we'll get up to $500 a share. The market discounts, it looks forward, and if the market gets kind of as optimistic as I do, and in 2029 starts looking.
Sorry, before they remove the graph, I just want to say it seems like the graph is logarithmic. Okay, the bottom part of this chart is big, every 50 is big, and then it gets smaller and smaller and smaller. So please take this into account. But the formula is the same. They think earnings will continue to go up. And maybe the growth rate will accelerate because of AI implementation and synergies we will see. Not today, but in a few years, right? Not today.
As I do, and in 2029 starts looking forward to the new decade. I think we'll be discounting something like $500 a share in earnings, and you multiply that by a PE of 20, and you get 10,000.
10,000. Yeah.
And where do you
All
get
right.
those numbers from? Those operating earnings?
Well, basically, I extrapolate what the growth rate of earnings has been in the past, and it's usually 6, 7, 8% is the kind of trend growth rate that we have. And the question is it going to be 6 or is it going to be 8? And I've got more the optimistic side. So, I start out with a projection of revenues, then I come up with earnings, and I look at what the implied profit margin is and say, well, is that reasonable? And so I think this is a reasonable scenario. And again, I'm not trying to pretend that things couldn't go awry, but so far so good.
Figure 10, John, forward PE of the S&P will range from 18 to 22 over the rest of the decade.
Right.
I feel like there's a portion of the investor population,
This is important. Now pay attention.
professionals, who just feel portion of the investor population the rest of the decade.
Right.
I feel like there's a portion of the investor population, mostly professionals, who just feel this like almost magnetism toward a 15 PE, a mythical PE that, of course, we could see it. We temporarily had it in 22, and if we have a recession, you'll definitely get it again.
Right.
But absent that, like 18 to 22 seems to be like the new standard range, and I hate to say it out loud because that's probably
we don't want to use that curse. We don't know what it is, but
permanently high plateau. We don't want to say things like that.
This time it's different, but look, it all depends on what you think about the prospects of a recession. The economy, since the beginning of the decade, has absorbed a lot of shocks, as I said. The pandemic was immediately followed by a 2-month lockdown, causing a
This is a point from Tom Lee. He says the same thing. Look at this.
2-month recession. The 2-month recession was followed by social distancing, which affected services. Social distancing then was followed by, we had a war. Russia attacked Ukraine. So in 2022, 2023, we had a spike in inflation because of the war and because of supply chain disruptions. The Fed came in and went from 0 to 550 basis points on the Fed funds rate. Everybody said that's definitely going to cause a recession. I disagreed with that. I said the Fed's going from 0, which was the abnormality. 5.5% wasn't the abnormality. And I kind of took a stance that the economy would be resilient. And then what? Well, then nothing happened. No recession when the Fed raised interest rates, and now we've had tariffs, so we're we're testing the Smoot-Hawley thesis that, the idea that this is going to end badly the way the 1920s ended, which was really something that happened in 1930. And here we are with the economy at an all-time record high. The challenge today, of course, is the labor market. Kids coming out of college are finding it very, very hard to find a job. I think part of that is AI. The baby boomers are retiring, but not at 65. They're kind of hanging around, and that's creating fewer maybe job openings. But whatever is the problem in the labor market, I think the fact that GDP has been so strong is proof positive that we're kind of in a productivity boom, and that's the whole thesis of the roaring 2020s. Like the 1920s, is that there's a technology-led productivity boom, which generally speaking, there's nothing wrong with it. I think maybe there could be a couple of years where people have to kind of reskill themselves to find jobs, but productivity is like fairy dust. It's better growth, lower inflation, better real wages, and a better profit margin.
Yeah, and I think just that concept of having the boomers still living and spending in their 70s as though they're in their 50s, and supporting grandchildren like people in their 30s would have supported their own children.
Correct.
That's a really big element, especially in places where we live, like Long Island, Ed. And I think I guess it's a demographic thing that was hard to foresee 15 years ago, but that's sort of how it's playing out.
I mean, look, there's no doubt that there is an affordability issue. It's become a hot political topic of late. We know that, you go out to a restaurant, you go to a grocery store, you buy, auto insurance. I got 5 kids, and the youngest ones are in their 20s, and insurance just for one is $4,000 a year. I mean, there's no way kids can afford that. No. So I think there's a lot of parents helping out their young adult kids. And, that's kind of helping to offset the affordability issue for some people. Of course, there's a lot of people that are doing very poorly here. But from a macroeconomic standpoint, when you add it all together, the consumer on balance has been remarkably resilient.
I want to get to the result of the exercise. Figure 11, you have the S&P 500 on track to rise to 9,000 to 11,000.
Correct.
Based on the earnings expectation and the potential multiple that we talked about.
Right.
By the
Yeah, every year Ed Yardeni creates this model where he makes forecasts about where the S&P 500 will go. This is the forecast.
End of 2029. So that's 10,000 by the end of the roaring 2020s, which you note would be up from 3,230 at the end of 2019, representing an increase of 210%. And you ask rhetorically, is that amount of gain delusional? Not really, since it was exceeded during 3 of the previous decades.
Right.
Since the 1920s. There have been 3 roaring decades in which the stock market gained over 200%. So what you're laying out here is not only feasible, there's precedent.
Yeah, take a look at, can you flash figure 12 on the screen? Yeah,
Here's,
there we go.
Okay, now they will talk about some decades where a lot of investment gains are made when stocks go up a lot. Will they talk about the starting valuation, the starting point? It's not the same. Now the PE ratio for the S&P 500 is rather high. So the starting point is high. Can you really have an extraordinary return coming from a high PE ratio at the beginning? Not sure. Not sure they will talk about this. I don't remember. But yeah, for some companies, for some periods, especially the 80s, the PE ratio at the starting point was extremely low. So yeah, it's normal. Same thing for the decade between 2009 and 2019. The PE ratio after the great financial crisis was extremely low.
Walk us through this.
Yeah, I mean, that's straightforward. It's the decade percent changes going all the way back to the decade of the 1920s. And we've exceeded 200% a few times here. We did it in the 20s. We did it in the late 40s, and then we
almost did it last decade.
Yeah, almost did it last decade. So the bottom line is that there's nothing unusual about a roaring stock market. We've had it before.
So they don't mention the starting point, the valuation. Maybe it would be lovely to have this same chart, and at the beginning of each chart you have the starting point, the PE ratio at the beginning of the decade.
Almost did it last
That would be a little bit better, that will give you more indication.
decade. So the bottom line is that there's nothing unusual about a roaring stock market. We've had it before. And just because I make the allusion to the roaring 1920s doesn't mean that it's that unique.
I want to finish by just telling you it's so refreshing to listen to people of your generation who are optimistic about the future. I think there's sort of like a disconnect sometimes when you're talking to people who have seen a lot of history, and you would expect them to be more optimistic given everything that they've witnessed in their lifetime.
Yeah.
But it goes the other way. In many cases, they sort of feel like the golden era is long gone, and all that's ahead of us is misery and strife and class warfare and all the problems that we read about each day. But you have very notably gone the other way. You've been right from an investment perspective, and I think you've sort of served as a beacon for people that want to hear somebody with wisdom and experience say something positive.
So a lot of information here. Basically, we are maybe entering a new golden age with AI, and Ed Yardeni, that has been here for so many decades, is extremely bullish because he thinks earnings will go up. Now, do you agree with this? Do you agree that the margins will continue to go up, that the profits will continue to go up? And if you believe this is the case, where do you invest? So you only want to be invested in companies that are growing their earnings, right? You don't want to invest in unprofitable companies or companies that are decreasing or stable. You want companies that are growing their revenue and they are growing profitably. It's a good way to reverse engineer how you can invest, so you are not wasting your time on bad opportunities and you can only focus on what matters so you can outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.